IPOs are one of those events on Wall Street that can generate enormous excitement and euphoria, but history has shown on numerous occasions that buying a highly anticipated IPO immediately after it begins trading does not always work out well for everyday investors, especially within the first few years after the listing. In this video, I'm going to explain why this can happen. First, I'll run you through how a typical IPO works, and to explain it, let's look at the largest IPO in history, SpaceX. SpaceX priced its IPO on June 11, 2026, and its shares began trading publicly on June 12. An IPO, or initial public offering, is the process through which a privately held company offers shares to public investors for the first time and lists those shares on a stock exchange. The IPO process is led by a group of underwriters, including banks referred to as the joint bookrunners. Its joint bookrunners included some of the largest investment banks in the world, such as Goldman Sachs, Morgan Stanley, Bank of America. During a process known as book building, the banks meet with prospective investors around the world and collect indications of interest. For example, and these numbers are completely hypothetical, one institution might indicate that it would be interested in purchasing a large number of shares at, say, 120 each. Another might indicate strong demand at 140, while a third investor might be interested only if the valuation remains below a particular level. The information gives the company and the book runners an idea of how much demand exists, how price sensitive investors are, and how large the offer can realistically be. To use an everyday example, it's a little like a house inspection before an auction. The real estate agent, in this case playing a similar role to a bookkeeper such as Goldman Sachs, shows prospective buyers through the property and tries to understand how much they might be willing to pay. The agent speaks with potential buyers, builds interest, and develops an idea of how much demand exists before auction day. However, an IPO is not exactly the same as an auction. Before public exchange trading begins, the company and its underwriters allocate shares to the participating investors at the final IPO price. When the stock begins trading on the exchange, buy and sell orders from the broader market determine the opening trade price. If public demand is extremely high and relatively few shareholders are willing to sell, the first public trade can occur significantly above the IPO price. This is where investors who did not receive an IPO allocation can be placed at a disadvantage, particularly when there is enormous hype and excitement surrounding the company. For SpaceX, the initial public offering price was $135 US per share. Now let's look at opening day. Although SpaceX IPO price was $135, its first public trade occurred at approximately $150 per share. That was already an 11% premium to the IPO price. By the end of the day, the stock closed at approximately $161, representing a gain of approximately 19% from the price paid by the IPO subscribers. Returning to the house example, imagine that a group of investors purchased a house for $1 million before it was made available to the wider market. When broader bidding begins, the first transaction values the same house at $1.1 million. By the end of the day, someone is willing to pay almost $1.2 million. The second buyer has now paid more for the same underlying asset. All else being equal, paying a higher price reduces the buyer's margin for error and lowers the prospective return available from the investment. This doesn't automatically mean the higher price buyer has made a bad decision. The higher price could still be justified if the business performs better than previously expected, or if new information supports a higher valuation. A principle commonly associated with Benjamin Graham's value investing framework is that future return available from an investment is heavily influenced by the price you paid for it. Let me show you what that means for SpaceX investors so far. As of July 24, SpaceX's shares were trading at approximately $115. For someone who purchased at the IPO of $135, that represents a decline of around 15%. Using our house example, a property purchased for $1 million would now be valued at approximately $850K. An investor who purchased at the first day closing price of $161 is now down 29%. So their $1 million equivalent investment would now be valued at approximately 715K. And that only measures buyers at the closing price. During the initial excitement, SpaceX's shares traded as high as approximately $177 on their first day. So an investor who purchased at that price and continued holding at 115 would now be down 35%. So their 1 million investment, using our house example again, would now be worth approximately 650K. The enthusiasm continued beyond the first trading day. On June 16, SpaceX reached an intraday high of approximately $226. Compared with a price of around 115 where it is now, that represents a decline of almost 50%. So that $1 million investment in that home made near that peak would now be worth approximately 510K. Just to be completely clear, I'm not saying that a short-term decline proves SpaceX is a poor company or a poor long-term investment. Long-term investors such as Warren Buffett and Jack Bogle have repeatedly cautioned against treating short-term market movements as a reliable measure of a company's long-term business value. What I am saying is that investors who paid a substantial premium above the initial offering price accepted less room for error. Public investors who purchased at that 161 price, 177 or 225 were paying significantly more than the IPO subscribers that paid only days earlier. Imagine buying a house for 1.2 million when people in the neighborhood know that it changed hands for 1 million only 1 week earlier. The earlier $1 million transaction does not prove that the house is worth only $1 million. The first transaction may have taken place under different conditions or new information may have emerged. However, when you eventually try to sell the property, the next buyer will want to understand what justifies the higher valuation. Has new public transport been approved? Has better infrastructure been built? Is population growth increasing demand in the area? The same principle applies to a company. An investor who purchased SpaceX at 177 paid $42 more per share than investors who received shares at the 135 IPO price. For that additional price to be justified over the long term, SpaceX would generally need to deliver stronger business performance, command a sustainably higher valuation, or achieve some combination of the two. The market will therefore focus on questions such as, can SpaceX continue increasing its revenue? Can the company improve its profit margins? For example, SpaceX's recent revenue growth prior to the IPO has been impressive. In 2025, revenue was approximately $18.7 billion, representing a growth of around 80% since 2023. At the most recent share price of 115, that gives it a price to sales ratio of 80 times revenue. The price to sales ratio is calculated by dividing the company's total market value by its annual revenue. SpaceX's multiple at the IPO was substantially higher than the multiples of several of the largest technology companies at the time, including Nvidia, Amazon, and Meta. Again, that doesn't necessarily mean SpaceX should trade at the same valuation as those businesses. SpaceX operates in a different industry, faces different risks, and may have different long-term opportunities. The comparison simply illustrates how much growth and future profitability investors may already be expecting from the company. Price to sales is only one valuation measure. There are many others. SpaceX is scheduled to release its second quarter financial and operational results in August 4. This will be its first earnings announcement as a publicly trading company. It's going to be interesting to see how revenue, profitability, Starlink's growth, and the company's future outlook compare with the enormous expectations reflected in its valuation. It will be fascinating to see where SpaceX takes off to from here. Thank you for watching. If you have enjoyed this video, please subscribe to The Experimental Economist.